What's up, everyone? Yesterday, my company Refine Labs just made an incredible announcement about Demand GPT. We launched a AI based niche LLM that's trained on all the learnings and experience that we've had at my company Refine Labs, with more than 450 hours of collective work. More than 100 different experts have produced information for there. There's forecasting models. There's step-by-step implementation guides. There's advertising playbooks, anything around demand gen marketing that you want to know. And all you have to do is just go in and type in a question. What are the best metrics to run for my LinkedIn ads? Enter, and you're going to get the answer. You're going to get the source content. What are the best KPIs to present to my executive team? Enter. You're going to get all that information and all the source content. Right now, we're doing a promotion. If you use the coupon code CHRIS15 through May 15th, you'll be able to get 15% off the lifetime of your subscription. And the way that you go there is refinelabs.com/vault. Feel free to visit there, use the coupon code. It's a month-to-month subscription, so you can check it out for a month and then see whether you want to go from there. Appreciate if you want to check it out. I think it's a massive innovation and a huge value for anyone that's looking to either learn, optimize, or scale their demand gen programs. I just got off a live event with Kyle Coleman and Copy AI talking about go-to-market bloat. For those of you that don't really understand or haven't heard the term before, basically, like, especially in B2B tech and SaaS, like, go-to-market teams are totally bloated, and the financial metrics is the number one way to know that in terms of CAC payback period or return on marketing investment or return on entire go-to-market. Totally out of whack, which is then putting a ton of pressure on EBITDA profiles, making it almost impossible to hit Rule of 40. And I think on this podcast, we're going to continue to go further on the financial side. Kelsey asked about last week about how we could learn more about it. So we're going to spend even more time on this podcast, because even as an individual contributor, you have to be aware and understand the market dynamics and how the funding environment is happening, which is then driving how executives are looking at the financial metrics, which then hopefully should drive how they adjust in terms of their planning and the financial guardrails that they set, which is then going to drive how much budget that you all have to deploy for team and programs and things like that. And then also the KPIs and what you're expected to deliver. It all starts at the top. It all starts at the well of investor money, or in public markets, how that market cap and things like that. And then that money flows down, it goes into the company, and then it goes all the way down to individual contributors, and then the ecosystem of technology vendors and agencies and everything like that. So I promised a spreadsheet today. I looked at the spreadsheet and said, this is way too fucking complicated to present to everyone. So there's an alternative that I'm going to be using today that was produced by David Spitz and the Bench Sites team, using public company SaaS data. And if you aren't aware, you're not following David, and you're not, I don't know much about what their company's doing, but the content that they're publishing is awesome, about the amount of money that companies are spending on sales and marketing, the CAC payback periods around that, the return on those, the growth rates of those companies and how it changes by growth rate. And the beauty of public company data is all of that is public and all of that is reported. The funny thing about private company data is that none of that is publicly reported, and people are not required to report it. But at Paceto, we've seen more than 50 companies' data, and we see similar trends of what they're seeing. In fact, most private companies are performing worse than the public company data that David is reporting. So I'm also going to be having a conversation with David. I'm going to be bringing him on the podcast. Maybe we'll even have him come on live to this show, because I think the work that they're doing to expose some of these issues, I think is incredibly impactful and going to drive a lot of benefits across the entire B2B SaaS and tech ecosystem. In terms of go-to-market bloat, I'm just going to start with a couple of these, then I'm going to get into some of the data. What are some of the things that are causing go-to-market bloat? Go-to-market bloat being that go-to-market teams effectively spend way too much money on a combination of people, programs, processes, and technology, and do not get anywhere close to the appropriate return, which causes massive issues downstream in the financial metrics. Why? Because sales and marketing costs are by far the most expensive costs on the entire P&L for a B2B company. Most B2B companies will spend somewhere between 2 and 3 times as much on sales and marketing every year as they will on product development, engineering, and R&D. And so if you want your company to be more profitable, what is the number one thing that you need to do? You need to figure out how to get the same amount of customers with way less investment on sales and marketing. And so what are some of the root causes of this? Number one root cause is the way that the planning happens inside of the executive team. And so most executives will still say, how do we decide how much we spend on sales and marketing, and use a percentage of revenue to determine how much they spend on sales and marketing. So they'll say, okay, we're a 100 million ARR company. We're going to spend 50% on sales and marketing because that's the benchmark that we found from whoever provided the benchmark. And so we're just going to spend $50 million on sales and marketing. Meanwhile, their growth rate's 10%. So they are going to get $10 million in net new ARR, and they're going to spend $50 million in order to get there, which yields a 5-year CAC payback period, which is entirely unacceptable and never going to work. And then it puts a ton of financial pressure on the EBITDA line item, where they probably need to find 35 points, which means that they probably appropriately should be spending $15 million on sales and marketing to get $10 million, but instead they spend $50 million. So number one is the planning and how the budgets actually get set across the entire go-to-market at the C-level. The number two issue is the over-specialization of roles inside of the go-to-market team. When I started in B2B companies in 2012, and even up to 2016, 17, we had an account executive, and that account executive was based in the field, owned a territory, and was responsible for prospecting, closing deals, onboarding customers, making sure they were successful, and expanding them. And now today in a B2B tech company, you have to do, one person used to do that whole job, and now you have an SDR, an AE, a solutions consultant, an onboarding manager, a customer success manager, and an account manager do the same fucking thing. 6 people doing the same thing that one person used to do. The over-specialization of roles, specifically in that area, will be fixed because it's not financially viable anymore. Additionally, inside of, I think, in the marketing team, there's been an incredible over-specialization. Back in the day, when I was a marketer, they just called you a marketing manager, and you were responsible. I had to do SEO and content and marketing operations and field marketing and building trade show booths and creating content and doing thought leadership and enabling the sales team and making the brochures and going to sales meetings. And you were just a marketer that did all of marketing. And now all of a sudden we have 7 marketers that used to do the same thing that one person would do 10 years ago. And there's been an entirely over specialization of marketing, which I think is doing a very strong disservice both to companies, but both to marketers as well. Like, specializing is great. You can build a career off of being the best person at Google Ads or being the best person in SEO. But to be a true marketer, you need to be able to do all of the things. You need to be able to do product marketing, understand customers, be able to create demand, run field, work with sales, ideally actually even close deals. And so there's go-to-market bloat happening there. We spend almost this entire podcast talking about how B2B companies overspend on programs, specifically Google Ads and large trade shows and conferences and events with no ROI. That creates a very bloated expense. And then you add all of those things up, and all of a sudden, it's just costing you way too much money to run your go-to-market and acquire a customer. I think the stat was that it from 10 years ago to now, it's 5x more expensive for a B2B company to get a customer than it was 10 years ago. So back in the day, a private B2B company probably had a CAC payback period of 12 months. That was the benchmark that I used to look at in 2014 and 2012. And now our data shows it's 48 to 60 months, 4 to 5x higher to get the same customer, caused predominantly by this effective go-to-market bloat that needs to be resolved. And so Sydney, if you could, let's pull up that data. I think I took a screenshot on my phone, and we're going to use that. So I hope it's clear enough for people to see, and I hope it's clear enough for me to see as I present it to you. I'll pull it up on my phone because I can't see it. So what you're seeing here is the 2023 data of, what do we have here? 80 public SaaS companies. There's 80 publicly traded SaaS companies. They've been segmented by their growth rate. You can see ARR growth on the left-hand side. You have companies that are contracting. Their revenue is going down year over year. There was only 3 companies in that segment. And you can actually go and you can look and you can see the exact companies that are contracting or that fit into each of these categories. Then you have companies that are growing 0 to 10%. You have companies that are growing 10 to 25%. And then you have companies that are growing 25 to 50%. It's important to note that these are publicly traded companies with large market caps. And so there's no company on here that's growing, 100% like you might see in a private company that's doing 3 million ARR. These companies are growing, the group in 25 to 50% growth are growing by hundreds of millions of dollars every year of net new ARR. So just let's put it into context of the size and scale of these companies. And then on the left-hand side, you can ignore the include SBC, exclude SBC. Let's just look at the included SBC. SBC stands for stock-based compensation. So let's just look at it all in. So just look at the left-hand column of each of these breakdowns. The first side is the sales and marketing expenditures as a percentage of revenue. That's how most companies decide how much money they're going to spend on sales and marketing. You can see companies that are growing faster tend to spend more on sales and marketing. So companies that are contracting and ARR is declining actually still spend 35% of revenue on sales and marketing, yet their net new ARR is negative. That's an issue. And then you have companies that are growing quickly, 25 to 50% year over year growth that spend up to 50% of revenue on sales and marketing. But then as a comparator, what I talked about last week and was going to present here, I think this is a great way to present it, that on the right-hand side, you have sales and marketing percentage of net new ARR, and then you could invert that to get to CAC payback period. So I'll explain this. You can look at the 0 to 10% growth category, right? They spend on average 34% of revenue on sales and marketing. And then their sales and marketing costs as a percentage of net new ARR is 574%, which means that they have a 5.7-year CAC payback on their investment, which is totally unacceptable and not gonna work long term, which is why a lot of those companies' market caps are declining. Then you see even the highest performing companies, literally, what is it? The 22 best SaaS companies in the entire world, publicly traded, growing 25 to 50%, literally the creme de la creme of SaaS companies, spend 50% of revenue on sales and marketing and have basically a little less than a 2-year CAC payback period on their entire investment. But these companies are massive. Most of the revenue they get through brand and word of mouth and customers and people knowing about them and things like that. There's tons of organic acquisition happening at these companies, and still they have a 2-year CAC payback period. And so if you take this and try and translate it to your 50 million ARR SaaS company and say, okay, we're going to spend 50% of revenues on sales and marketing, there's absolutely no way that you're going to achieve that metric of a 2-year CAC payback period. What we see is typically 48 to 60 months, which would be more like the thing that you see at the top. So that would be 480% to 600%. And so you can see that most companies are going to budget off of sales and marketing as a percentage of revenue, the left column. And what I'm suggesting is that companies consider an entirely new framework where the process starts not as how much should we spend as a percentage of revenue, but instead, what do we want our CAC payback to be across our company? What was it last year, and what do we need it to be? And then everything changes downstream when you start your planning process and say, we need to achieve a 24-month CAC payback period instead of we're going to spend 50% of revenue on sales and marketing. It changes absolutely everything. What would change? You'd spend, my estimate is somewhere between 2 to 3x less. So you decrease your sales and marketing budget by somewhere between 50 and 67%. That doesn't mean that we're just going to have to do this like big layoff and things like that. There are strategic ways to be able to make this happen, but there will be cost cutting. There's no way around it. Companies are bloated and spend way too much money and have way too many specialized resources. You can see, and then you can look at the category here. I think the most interesting one is the 10 to 25%, because most private companies that we analyze are within that range. They're growing somewhere between 10 and 25%. There's not that many hyper growth private companies anymore. The amount of unicorns out there is way down. And so most companies are going to be pumped if they grow 15 to 20% next year, and they get 5 to 10% through expansion, and they get the other 5 to 10% through net new ARR. And so here, the 10 to 25%, they spend 40% of 39% to be exact of revenue on sales and marketing, and they have basically a 2.5-year CAC payback period of 30 months on average. And there's 40 companies that fit into that category. Most companies are growing at that rate. Most private companies are going to spend somewhere between 40 and 50% of revenue on sales and marketing. So just like that, they're in that range, but there's no way they're going to achieve that type of return on sales and marketing against net new ARR, because they don't have all of the organic market demand that's created through when you're a public, highly successful company. You're just not there yet as a company. So my estimate is that number doubles to about 500%. And so that gives you a little bit of a view of what's happening in the private markets. I added some anecdotes. It's not really anecdotes anymore. We've analyzed 50 private private B2B companies, mostly SaaS and tech, but also in other industries, and see that the data and the performance inside of private companies is even worse than the data being reported from public companies that has to be reported, but private companies don't have to report that data. And so what does that mean? The number one thing that you need to know as an employee is that those numbers inside of your company drive how much your stock is worth. And that most employees don't know it right now, but their stock that they own, their stock options, are effectively worth zero after you factor in preferred returns for investors. There's somebody that I know, a good friend of mine, that 3 years ago, the stock that he has in a company, he was employee number 7 at a company, and his stock that he owned was worth more than $1 million. And the company was supposed to IPO, and he was supposed to make $1 million. And today that stock is worth almost zero, like 60 grand. It's a big difference for somebody that spent 8 years trying to help build a company to more than 100 million ARR. And there are, CMOs and other people like that have dedicated that much time, have done incredible work. And because of both the valuations, but also the irresponsible raising of money from executives, have caused a lot of people inside of the companies to do a lot of work and to think that the stock options were going to give them basically a life-changing financial event that is no longer viable. Maybe in 2 or 3 years, they'll be able to get there and something will be able to change. But some companies are going to sell for a 1-to-1 where employee stock is basically worthless. I'm not here ambulance chasing. I'm not trying to make everyone feel sad. I'm just telling you the reality of what's happening inside of the market. And so with all that, what can we do? What can we do to change this? We can look at these metrics inside of our company. As an executive, we could try to run a scenario where we plan against having a 24-month CAC payback period across our entire go-to-market, instead of saying, I don't have enough, being the CMO that says, I don't have enough budget. My budget got cut by 20%. We're never going to hit our goals. And instead saying, well, even though my budget got cut by 20%, we're still not going to hit a 24-month CAC payback. That means most of the things that I'm doing as a CMO are not effective. I need to change the things that I'm doing. And if you take that model as an executive and you try to run that model, what it's going to lead you to do is say, okay, the incremental things that we've been doing for the past 10 years aren't going to get us there anymore. Trying to improve our email open rates by 3% next year, trying to get our demo conversions from 5.2% to 5.7%, trying to get a couple more of our free trial signups to convert to a paying customer, trying to get our outbound connect rates from 0.5% to 0.7%, trying to get our Google ads cost per lead from $50 to $46. All of that shit is nowhere close to going to get you to where you need to be anymore. There needs to be transformational changes that start at how we financially plan and what we plan for in the guardrails, and then downstream the metrics that we use across the teams to be able to know whether we're on or off track. And so I hope we can keep this. Hopefully this was educational for you all. I will remain on my commitment to show in more detail a sheet as we continue to go through this, but I thought this was a good place to start to get feedback and questions from all of you. Hopefully we can continue the education. I'm going to talk with David on Thursday. I think it'd be really helpful to have him come on and maybe be able to answer some questions for people that want to increase their financial acumen and understand this better. So we're going to stay on this track. I know we're very heavy signals. We spend a lot of time on that. Sydney and Trevor and myself are doing great work in the background. So we're going to continue to push that forward so that we have more to report on. But in the meantime, I feel this is critically important to share with all of you about what's happening from a financial perspective. And so with all of that, would love to have some discussion and answer questions. Thanks all for being here.
There were a couple of comments in the chat about different hats that people have to wear. So I'll leave those questions for those people, though they're absolutely really brilliant questions. So my observation is, Chris, is that the speed with which we are expected in our companies to grow now, the velocity of growth, the expectation is higher than it was 10 years ago. And that was higher than it was 20 years ago. And that was higher than it was 30 years ago. And I think that increased expectation for growth to come more quickly is what drives this inflation in program spend and perhaps people bloat, as you were kind of coining the term, because we don't have time. We can't grow at the old rate that we used to grow at. That's no longer acceptable. And part of that is because there are so many more competitors in every category today than there ever used to be. So the slice of available pie, if you will, within that category, you kind of want to grab enough to be sustainable, or you're not sustainable. So that's my impression based on my experience, but I'd love to get your sense on how much you think that perhaps self-imposed, perhaps it's investor imposed, perhaps it's competitively imposed pressure to scale. I'm careful about that word, but to grow anyway, is causing people to kind of like go big or go home. That to oversimplify it on an extreme. So I'll stop commenting and let you kind of react and share some of your thoughts on
that. I just see things have changed a lot over the past 2 years or 3 years. I see most companies that I interact with, and we should talk about what tier and maturity of companies you're talking about, because most companies that I interact with are going to be pumped if they can grow 20%. They're scared they're not going to hit their plan to grow 20% from 100 million to 120 million, where 3 years ago, that same company would try to grow by 50 or 60%. And so I'm seeing expectations being tempered a lot because it's reality. Like planning to grow from 100 million to 150 million when you're not sure if you're going to grow by 10% is just setting the entire company and the investors in the C-level up to fail. And so I do see tempered expectations coming both from the executives that do the planning, but also from the investors at that maturity level, from maybe like what you would call mid-market company, 30 million to 300 million, in that range. Like that's different. When you look in the smaller end, I think that those companies continue to be very optimistic around trying to grow from 3 million to 10 million in 1 year and have 333% growth and try and, triple, double, or whatever the thing is. I think a lot of those companies will continue to run into issues, but luckily for them at that type of scale, like it's very difficult to be so bloated where it kills you. And so I think that early stage companies continue to be unrealistic about their planning. Nothing has changed about that. I worked in those companies as an employee from 2015 to 2019. I saw the planning. I saw what happened. Never thought about customer acquisition costs. Just took investors' money, poured it into mostly sales and SDRs, and missed the entire plan. So I don't think that the expectations are changing. But when you look at real players with experienced executives that have been there before, the companies that as an employee you want to work for and the people you want to learn from, and the companies that are probably going to have the highest probability to be successful, those people are smart, and those people have esteemed investors, and they understand reality of what's happening in the market, and they think on a longer time horizon. Like the private equity companies that invested in them are thinking on a much longer time horizon than the VC that did your seed round. And I think for all of those reasons, those people are having realistic expectations to growth, where they're planning for, their stretch plans 18, 20%, but what they're reporting back to investors is they're going to grow by 12 or 15%. And that, to me, like that's a highly realistic plan to try and go from 100 million to 110 million, especially when you're spending 40 or 50 million dollars on sales and marketing. So while the financial metrics don't make sense, I do see, specifically on the growth rates, I do see those being tempered from experienced executives at more mature companies.
I would agree with that, of course. And again, you raised the point of, well, what stage in the business are we talking about? Are we talking about earlier stage, less than 50 million? Are we talking about 50 million plus? And how the go-to-markets generally change once you get to a certain size, because you start to cross-sell and upsell and do add-ons and so on into existing accounts, rather than necessarily always having to acquire brand new business all the time. You evolve. So that's a really, really important point. And perhaps that's worth having mentioned in the first place, because that pressure to get to that scale exists at the beginning of a company, which is when a lot of those bad habits get formed. And as it gets bigger, then perhaps it kind of weans itself off of the bad habits, is perhaps one way of kind of figuratively speaking about it. Anyway,
Yeah.
thank you. I appreciate your comment. Thank
For
you.
sure. And like, it's not like a perfect science, but for the most part, like, I choose not to work with companies below that revenue range for that exact reason. So that's one thing. Like, I don't want to deal with that shit. Like, the people, they don't have the right mindset. They don't really understand sales and marketing. Many of them haven't done it before. They don't really understand they have a strategy problem, but they think it's like their advertising, or they think their SDRs should be better, or things like that. But really, people just don't want their fucking product, or the product isn't ready. I just choose not to work with those companies anymore, because it's a variable in the equation of the success that I'm able to deliver to that customer that I can't control. Another thing that I'll say is that those really, like, the try and win the whole share of the pie, go big or go home type of deal for early stage companies is really being challenged right now, because there's a lot of people that started their company in 2011 and did the go big or go home and actually went big, and still just the founders that took secondary made money and nobody else made any money. And so I think there's a lot more. I love the work that Rand Fishkin is doing, and Sydney, who's the guy that talks about what's his name? You know it. The guy who talks about bootstrapping SaaS companies. Whatever. I'll find.
I'll try to read your mind and drop something in the chat.
Yeah,
if I think
talking
about it.
The Practical Founder podcast. That's his podcast. I don't remember his name off the top of my head, but there's a lot of people challenging that model, because in reality, as a founder, you have two options. You can like go and raise a bunch of money all the way through and try and build a unicorn. And then at the end of the unicorn, if you have two other co-founders, you might own 3% of the company when you sell it, because of all the dilution that happens. And then you could try and like raise money all the way through and build a $1 billion company and own 3%. And what is that? $30 million. Or you could raise no money and bootstrap your company and get it to 10 million ARR, and you still have three co-founders, and you sell it for 200 million, and each of you make $67 million. And instead of having to build a $100 million company that's worth $1 billion or more, you could build a $10 million company that's worth 100 or 200 million and make the same or more amount of money with none of the headaches. And so the financials for founders, the VC financials, I don't think make much sense anymore, unless you're trying to build the next Facebook or Uber, or even WeWork, the founders made money even though the company failed. So
Greg Head is the
Greg
name.
Head, thank you. So
You're welcome.
there's a big challenge around that of like, do you actually need to go out and build that unicorn and be super unprofitable and spend 80 hours a week and the entire company's stressed out, and then even when you get there, the financial payoff isn't really there. So that's been a big realization for me as I started my next company, Paceto. Like, maybe we'll go slower. Maybe we won't win the category. Who cares? Like what matters is, what do you want as a professional? I want work-life balance. I want to be able to have a team that has work-life balance as well. I want to do great work for customers. I want to make an impact. I want to have a strong financial return. I want to have control over my company. When you want those things, what do? You don't raise institutional capital.
Thank you.
Thank you.
All right, we got a couple more lined up, so I'm going to keep it rolling here. We're going to bring on Matt Wainwright.
Yeah, this actually comes out of Dave's points towards the end of his thing pretty well. One thing I've seen, and this is with a very small sample size, is a couple people say it's not about net ARR. It's actually about true holistic LTV. And so I'm wondering if you're seeing that as well at all from people saying we're not really focused on the net new, we're focused on the total package.
I've communicated this perspective a lot, and interestingly enough, like David Spitz also agrees and communicates the same perspective. So him and I are very much aligned on this as he looks at public companies and I look at private companies, is that LTV is a made up number for most companies. It is projected into the future and made up. Most companies are like, yeah, our customer's going to stay for 7 years and they haven't even been in business for 7 years. How do they know? And so I think, sure, like be looking at customer acquisition cost to LTV, like, sure, you can look at that, you should look at that, but know that most of it is made up. And that CAC payback period, all that does is it creates a much more tight, finer line in the sand that's actually objective, that says this is how much we spent, this is how much the customer pays us, this is how long it's going to take to get us back. So I don't think you have to choose one or the other, but I think the CAC payback period or percentage of net new ARR against sales and marketing investments, that you get to the same number either way, that is the primary number that companies should be using. And then what we see a lot of our customers try to do is try and say, oh, well, here's our CAC to LTV for the enterprise segment. And then they like fudge all the numbers of all the investments in sales and marketing SDRs to try and like come up with some assumption around how much it cost them to get an enterprise customer versus an SMB customer, when in reality they have no idea. And so I think that just there's a lot of assumptions that go into the idea of a CAC to LTV equation, especially when you try to look at it by customer segment. But even when you look at it blended, it's still, there's a lot of assumptions in it that I think that having a more direct calculation as your primary metric should be, is just a better idea. But you can certainly do both.
All right. Let's go ahead and bring on Michelle next. Sorry, Michelle. I'm just trying to, there's a couple of Michelles, so I'm making sure I got the right one here.
Yeah, thank you. So you really struck a chord when you talked about wearing multiple hats. I'll start by saying that we're a small, privately held company. And so we wear all hats. Things get thrown at my marketing team that you wouldn't even think is marketing, but it ends up coming our way just because we're marketing. So my team grew from 3 to now 7 direct reports. So I'm growing my team, expanding, some growing pains for sure. But we definitely went from a smaller group who did everything and was super capable of literally anything and everything, from copy to video to you name it, we could do it all. And now, of course, expanding my team, the newer hires, I hate to say younger generation, but a lot of them do happen to be, I seem to struggle with the dynamic, with the mindset, with, yes, they're more digital, which in that regard is fantastic, right? We're all about YouTube and videos and doing much more digitally than we did, say, 10 or 15 years ago. But there's definitely a difference in wanting, and of course, somewhat inexperienced, right? So that is definitely a point, but it goes beyond that. I'm experiencing it's even more of not wanting to learn at all, thinking it's too much, feeling overwhelmed, wanting to focus on maybe only one area or 1 or 2 areas and learning those. And so I'm kind of shifting my approach, and working with what I have and balancing the team, right? We're a bigger team, we're balancing each other, and that's good. But now I'm even at a point where I'm questioning if me changing my approach is the right approach for me and my team, because with fewer people, we got a lot more shit done. And I like to just get shit done. And now we have a lot more people, and I'm having to segment a lot of what we're doing, and it's decreasing visibility, and shit's not getting done as fast as it used to get done.
Mm-hmm.
We're doing more things, but it's just a balance and it's a struggle. And I sparked quite a bit of commentary on the chat. And so I'm real interested, Chris, to get your perspective and just hear your take on all of this. Clearly it's a challenge, for multiple people because everything's just changing so much.
Yeah, it's super interesting. I posed the question last week, among other things, but like, do you really need a marketing team of 50 people, or could you get more done with 8? And
Yeah, we're not 50. We're small. So,
for
7
sure.
with me, 8, that's a lot for our little, our company we have 160 people on staff across all departments. So a marketing
Totally.
team of
Yeah.
8 these days.
Just to call back to sort like, because I'm thinking the same thing. And there's a big trend. I've like on the last call that I had, Kyle Coleman at Copy AI has 4 people on their marketing team and they get a bunch done. I posted 3 years ago and said, here's how our 3-person marketing team produces more content every single day than what most 100 million ARR companies produce every single year. And like, it's not about the number of headcount. And when you have more headcount, what does it do? It creates more communication layers. It requires more specialized tools. Typically, you bring in less experienced people as you scale. So then you have these like management seniority layers. And for all of those reasons, while you feel like you'd go faster, you actually go slower. And so I love the trend of smaller, like more agile marketing teams that are filled with key, like basically you're like an executive level or a VP level person and you only have 2 or 3 of them and they're able to get things done. And then what do they do for the execution? You use outsourced resources. You figure out how to use AI. You figure out how to offshore some things. Maybe you have one specialist over time that's doing things, but basically small team. And what you need the architect layer. You need like the layer at your size and stage. It has to be you. And then so you need to be able to just basically be like, these are the things we're doing. These are the guardrails. And then you need people that are able to be autonomous and be able to go and take them. I do believe that people, especially over the past, I guess whenever the T-shaped marketer came out, probably late, like early 2010s, that marketers specifically have been sold a lie that the way to grow your career is to specialize and to be so good. And then all of a sudden you're so good at field marketing, but then you max out at director of field marketing because you can't be the VP at demand because you don't know anything about advertising or content or digital or marketing ops. And all you know how to do is run events and you'll never be a CMO. And I think that like me and many other people that have either worked in industries outside of tech SaaS or have been in their career for a long enough time where they were basically marketing was different back then. It was just called marketing. You did all of it. And I think that was a huge gift for me. And so I think that people, it tends to be people that seem younger, I think because of that lie that was sold over the past 10 years, that people that came up in their career that hadn't learned those things or seen that experience then heard that lie and said, oh, I'm going to specialize in a certain thing. I think there's just the narrative needs to be rewritten for people that are earlier in their career about what it actually means to be a marketer. It means that, like, what is a marketer? At its core, it's understanding customers the best in your company and figuring out how to advocate for that against product and promotion and pricing and everything else you do in your go-to-market, how you sell through distribution and things like that. And we just need to rethink what marketing means. When it comes to your specific situation, like, I guess you probably see two paths, right? Like, we could go back to our 3-person team and probably get a lot more done and have those things. Or we can keep our 7-person team where we can try and figure out what we need to do to change to be able to make our 7 team work more productively, right? Those are the two. Yeah. Those are the 2 options. Which one?
And we're choosing the latter. We're bringing in new tools. We just signed with HubSpot. We're starting that process this week. That's going to be a big new project. We now brought on Monday.com, to manage all the projects and visibility and all that. So we're bringing in new tools to really try to make everything more efficient. And of course, the more I train, the more I teach, try to make everybody more fully capable, because we just move more efficient when everybody understands what everybody else is doing and is capable of doing, a lot of the different things as opposed to just the one area that they're primarily focused on. So I just continue to keep training and putting more into each of my team members.
Here's my recommendation. You can try, but you don't have to try to make a zebra into a cheetah.
Right. Okay? And at one point, it's a question of it. Maybe it's just not the right people.
You don't have to. So, like, you have your stars, you know who they are. They want to do work. They're comfortable going in places where they don't know yet, and they're going to be able to figure it out. You have those people. And then you have the people that want to be the specialist and aren't going to go and do those things, and just know who they are in each category. And then for the specialist, you have to decide, does this person have a job that's a full-time job at my company or not? If they just want to do video editing, do I have a 40-hour-a-week job for them to do video editing? If they just want to do SEO, do I actually have a job for them? And if you do, then manage those people to deliverables, not to financial objectives or revenue. Say, I want to have, this is what I did when I started my podcast with Angelica Taylor, who's very experienced now, but wasn't back in the day. We need to have 3 podcast episodes go out every week. I want to have like 4 videos posted on YouTube. I want to have 7 videos that I can post on LinkedIn. Deliver this to me every single week and manage against a deliverable and a set of a metric, and then require your stars to then guide and say, are the things that we're doing actually moving the needle or not? And just be able to separate those 2 things. I think that's the best approach.
Yeah. Good. Thanks.
Yeah, there was a post recently that was like everyone in the go-to-market should own a number. David, actually, you commented on that. It's funny that I got here. Like, it's really hard to make your video editor accountable to pipeline and revenue. Like, super hard to make your product marketer own the pipeline number. It doesn't make any sense. And so there's many people that need to own deliverables instead of financial outcomes. And then you have your director VP layer that need to go and level up those deliverables to deliver a result. And I think just separating those 2, I think, is the most important.
All right. We are going to bring on Aaron next.
Hi, Chris.
Hey, Aaron. First
Big
time here?
Fan. First time here, yes, but I
Welcome.
listen to your podcasts often. Thank you.
Thank you.
And one thing I wanted to ask you about, I spent several years working for a company. They produced full ship charter themed cruises, and the owner was a little bit kind of kooky, I guess you could say. He was a disbarred lawyer, but I have to say he had a great pulse on his customers and his audience. He always could probably tell you the numbers at any given time, how many people had purchased a cruise on one cruise and also another cruise. And the expectation was that his employees would kind of have that same pulse as well. And I feel like that's lost on B2B leaders these days. And I just kind of wanted to get your thoughts on that. I hear a lot of leaders talk about acquiring companies or even merging companies, things like that. And they speak about it as if, acquiring this whole other database, it would be all net new leads for the business, not recognizing that there's probably already some crossover. Depending on the age of your company, there might be a lot of crossover there.
Yeah, let's separate these into 2. I see these as 2 separate topics. So let's separate them. I totally agree. It is lost in companies that employees should be connected with customers. In 2017, it was part of my bonus. I would not get a bonus if I didn't visit 3 customers a quarter in person. Our engineers had to visit 1 customer per quarter in person. And the entire company, and then obviously our field sales team and CSMs are visiting customers every day. And executives are seeing all these different customers for strategic reasons at events. And basically everybody is engaging with customers. I've never seen that on a marketing, like a marketing KPI or bonus sheet or some type of like scoring model for performance in any B2B company ever since I left that company in 2017. Any of the ones that I've consulted on, you'll never see a director of demand gen go out there and meet with customers or talk to customers, or it's very rare. We got some good ones in here on this call, I know, that do very often. And it's just, it's really hard to do marketing when you never talk to your customer. It's really hard. And so it's really hard to develop a good product. It's impossible to be a product manager, but it's even hard to be an engineer when you don't have the insights. Sure, you can hear what product marketing and product management are telling you, but having your own perspective on it, I think, is super, super important and super valuable to have the empathy. And when you're designing something or when you're writing code about what your customer cares about and what they're like. And yes, I do believe that has been lost. Some people try to replicate that by using a tool or buying a social listening product or something like that. And none of those things get you anywhere close to that. And so I don't know if it's a technology craze or the movement to inside sales or the movement to remote work or things like, because it was different in 2017. Like we visited customers all the time. We had a field sales team. We did, like, it was different. And so I underscore for you the importance. I think it's super important whether you're selling cruises or selling financial business software or selling industrial sensors into real estate companies, whatever. I think it's super important for every employee, even ones that are not customer facing or do not produce customer facing work, to at least have an understanding of what customers are like. Even the people that work on a manufacturing line for $12 or $15 an hour or 18, whatever the minimum wage is at this point, even those people, to be able to see the impact of their work, to understand how a customer gets value from what they're doing when they're only assembling this one little part, but then it turns into this big thing and it helps someone achieve something. We used to do that. In our medical device company, we had assemblers. They made whatever at the time, $15 an hour. They would put something together. But then when a bunch of people put a bunch of things together, we made a machine that saved babies that were born 10 months or 10 weeks prematurely, saved their lives. That wasn't where 10 years ago they would have died. And to have the assembler be able to just see that impact completely changes how they do their work. And so I think that having a connection to your customer and the outcomes of the product, the outcomes you produce as an employee at any level, I think is super important. Totally. Your second point around, I got so far into that, I forgot the second point. Could you remind me of what you were mentioning there?
I think you covered really the discussion point that I had, which was mainly around segmentation and just feeling like leaders are not as aware of the market, particularly with mergers and acquisitions.
And then just like for anyone that's live or listening to a podcast, my mindset from 2013 when I worked with Andy Midland, the consultant, all the way through my career is that I'm going to understand our customer better than anybody else in the company. And it's not a competition. We're not going to measure whether I understand it better than somebody else. It's just a mindset that you take that I want to be super connected to my customer. I want to be objective around the things that they want and the things that they actually do instead of pretending about the way I want it to be or that I wish it would be, which many people do. They don't listen to their customer. They project what they wish their customer did onto what their customer's saying. And just really taking the time to, and this is not fluffy stuff. This is how you build a business. This is how you deliver ROI. This is how you do great marketing, by really understanding what they care about and what they actually do, and then being able to reverse engineer, okay, here are the facts about what they do. So how can I use that to inform my strategy to make it work for me and for my team and for my company?
Love that. Okay, we have time, I think, for one more question. This one actually was a pre-submitted question, slightly off the core finance topic that we've been talking about, but related to signals. So this person asked, I'm trying to understand specifically how signals differ from or replace lead scoring. I'm kind of confused on the two concepts, how they work together or how they're different.
Lead scoring is a signal. It's one of potentially tens or hundreds of thousands of signals that your go-to-market team has. That's about as simple as it gets. And that one, like a lead score is basically a manufacture of, here were 7 things this person did, so that we're going to assume now that they opened 5 emails and then they clicked on that email that all of a sudden they're ready to buy. So let's have sales outreach. The signal becomes XYZ lead scoring model. And then you would measure the results of the XYZ lead scoring signal against the conversion from signal to connect, to meeting, to pipeline, to revenue. And what you'd find is that most lead scoring is total bullshit. And so that's basically to be able to create the distinction that lead scoring is a signal on its own, just like, and then you could have 7 different lead scoring models that are 7 different signals. And then you could have 7 different PQL scoring models that are specific to product usage that become 7 different signals related to product signals. And then you could have third-party review site data from TrustRadius and G2 and things like that, where you could have more signals that come from those vendors. And then even beneath those vendors, there could be different signals that come from those providers. And then you have your ABM platforms. And some of them actually tell you what the signals are, and some of them deliver you a black box. And then you have first-party website de-anonymization, which might come from HubSpot or Clearbit or our B2B or 6 cents, and then you have first party website data as another signal. And then even under that, you might have different providers and different signals. And then you have all your form fill data, and then you have all your event data, and you might have first party events and third party events. And so to recognize that there are a bunch of signals and lead scoring is just one of many signals, I think is the core answer to your question.
Yeah, I think one big distinction is there's a lot of people talking about signals right now. And a lot of people have different definitions for what they refer to as a signal. And I think we could probably clarify, Chris, what we mean when we talk about what is a signal in our context, because I think that's partially why there's some confusion in our signal content.
Yeah. So a touch point is any trackable thing that we can measure, typically measured by what used to be formed as a multi-touch attribution tool, or I don't know if you even consider Visible like a multi-touch attribution tool, or whether they call it something else, but like basically anything that we can track, let's log it. That is a touch point. We have a digital trackable event that we're able to put attached to a contact, most likely a contact, but sometimes an account. A signal is a much more narrow view by isolating. These are the things where we then deploy human capital, SDRs, sales resources, things like that, to try and then go and act on that signal to get a meeting in pipeline and revenue, which is the most expensive process inside of a B2B go-to-market engine. And the failure rate from signal to closed won is about 99.9% if it was measured properly. And so, but most companies do not have the data around all the times where sales is reaching out where they lose. So they don't see this, which creates go-to-market bloat. And so we need to be able to, and lastly, the signal has pure correlation to the conversion to meeting, the stage 2 win rate to closed won, the sales cycle length, the sales velocity, all these different metrics get determined by the signal that sales acts on. And when you look at large scale data, it becomes very clear every company is going to have a much better performance against their demo request signal than a cold lead they pulled out of Zoom Info or some ebook download that they got. And that is the most basic definition, or an MQL score, or basically any other signal. And that's the most basic thing to recognize between these two, is that the signal really, really matters in terms of sales productivity, sales velocity, marketing ROI, conversion to meeting, conversion to revenue. And so what we need to be able to do is isolate that specific signal that says this happened, an account or a person inside of that account did something that then triggered our sales team to go and take action, and what was the outcome of those actions. And looking at that specific thing is not the only way that we measure our go-to-market. I've gotten this question on LinkedIn. Oh, so now when we move to signals, what happens to all the other touch points? What do we do with multi-touch attribution? What about self-reported attribution? Signals are not the only way to measure the go-to-market, but it is the primary way to measure the most expensive part of the go-to-market, where more than 80% of the go-to-market investment is spent. And so signals can help you rapidly optimize that part of the process, which would most likely be able to help you save a lot of money and then go reallocate that money to demand creation, or, accelerating in pipeline deals by hosting dinners or other tactics that you use to win more deals or win enterprise customers, to focus more investment on expanding and making other current customers successful, rather than trying to have a SDR farm follow up with signals that never close. And so it's just the recognition that this is a very expensive part of the process. Most of the money gets deployed here. This is the proper way to measure this part of the process. It doesn't replace multi-touch attribution. It's not saying that everything that happens before that is worthless. It's just saying that we need to be able to isolate this part and use this part of the measurement system for that part of the process. So I hope that clarification helps. I think that we will have significant documentation coming out on this, where, to be 100% just like transparent and honest with you, we're questioning whether a lot of this information is going to be public or not. Maybe we will create a closed-end community for people to access it, because a lot of people are basically copying all the things that we're doing, and I don't like it and I don't want it to happen. So it's tough for all the people on here that, for Demand Gen Live and the things that I've done for the past 5 years, have gotten everything for free and open, but the world is changing and things are changing, and we're going to react to that. So either way, you'll be able to have access to it, but and I don't think we'll use a paid community to just be able to control where the information goes. we're not trying to make money off of this. Just to protect our IP, if you know what I'm saying. And so, yeah, that's the distinction between signals and touch points, I think, is a big recognition for people. And then secondarily, to know that signals is not the only way to measure your go-to-market, but it is the best way to measure the most expensive part of the process.
All right. Well, we got about 20 questions in the chat after that.
Really? We'll do a whole,
that,
let's do a whole signals episode next week. All those questions will queue up. So we'll do that next week. I'll be able to talk with David on Thursday. Maybe we'll have either a separate event or we'll have David come on David Spitz, come on to one of these events, and we'll talk finance again in a future episode. But let's pivot away from finance to the next episode, go to signals. We'll do a deep dive for everyone. It's going to help us continue to clarify and help people continue to grasp and grow the concept as we continue to develop it as well. So maybe Stephanie, whoever close it, let's not close out the Zoom so quick. Let's make sure we have all that stuff logged in the chat so we can use those questions for next week. Thanks everyone for being here. Hope it was valuable to you. Hope maybe you learned something about finance or something that helps you level up in terms of the way that you're thinking at whether you're a marketing manager or a CMO. It helps you level up and see what the level above you or a couple levels above you on the org chart are looking at and thinking about, or at least should be thinking about. So I hope that was valuable. And with all that, I hope you have a great rest of your week. We'll see you next Tuesday. Bye, everyone.